Hi guys. Today we will analyze Qualcomm stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. The long and short-term trends are both positive. Support level is around $160, then $140. Strong support level is around $120. Be careful. There is a gap between $140 and $160 levels on the chart. If the stock breaks $160 level, it may go down to $140 very quickly. Resistance level is around $190. In the last month the stock has been trading between $160 and $190 range, which is wide. It is currently trading in the middle of this range. It may be a good idea to wait for a pullback before considering an entry. The stock has an average volume of 10 million. This is a good sign as it is always nice to have a liquid stock. The stock is currently trading in the upper part of its 52-week range. The S&P 500 index is also trading in the upper part of its 52-week range, so Qualcomm is performing more or less in line with the market. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth, even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. Discounted free cash flow model, using the formula below, then, valuation based on earnings per share, 5-year average P/E ratio and expected growth rate. First model, discounted free cash flow valuation. This spreadsheet contains some financial data that we will use for the stock valuation. We see that the average revenue growth rate of the stock has been around 9% per year, for last 5 years. Also we see that the average profit margin of the stock has been around 11% per year, for last 5 years. Also we see that the average free cash flow to net income rate of the stock has been around 88% per year, for last 5 years. And we expect 8% per year average stock market return. Now, let's consider 3 different scenarios for Qualcomm Company: bad, average, and good. First scenario. Qualcomm will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be low, 4%. Future profit margin would be low, 12%. Future free cash flow to net income rate would be low, 80%. In this case, the fair value of the stock today would be $57. The second scenario. Qualcomm will have average performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be average, 6%. Future profit margin would be average, 16%. Future free cash flow to net income rate would be average, 95%. In this case, the fair value of the stock today would be $88. The third scenario. Qualcomm will have high performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be high, 8%. Future profit margin would be high, 20%. Future free cash flow to net income rate would be high, 110%. In this case, the fair value of the stock today would be $128. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for Qualcomm is 7.87. Minimum rate of return. I will use 12%. Because when we invest in individual companies, we are looking for a higher return than the S&P 500. For Qualcomm, analysts forecast growth rate around 25.62% per year in next 5 years, and future P/E around 18. Again, I will use 3 different scenarios for Qualcomm Company: bad, average, and good. First scenario. Qualcomm will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be low, 4%. Future P/E would be low, 14. In this case, the fair value of the stock today would be $57. Second scenario. Qualcomm will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 6%. Future PE would be average, 16. In this case, the fair value of the stock today would be $77. Third scenario. Qualcomm will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 8%. Future PE would be high, 18. In this case, the fair value of the stock today would be $102. As you can see, today the stock is overvalued, $179, even if we expect Qualcomm's high performance in future. There are some minor concerns on the company's financial health, and the stock is currently too overpriced. I would be happy to buy this stock when it drops below $120. If you think I'm too conservative, see what have happened with Facebook stock recently. Nobody expected such an epic fail from such a big company. So, we have to be conservative. We want to invest, not to gamble. Company strengths. Qualcomm is a designer and manufacturer of semiconductors for mobile phones and wireless applications. It provides integrated solutions, including processors, GPS, Wi-Fi, basebands and other applications, for smartphones, tablets, and laptops. The company is the market leader in wireless chips, with a leading market share position in 5G chipsets and relationships with every prominent smartphone maker. Qualcomm collects royalty income on the majority of 3G, 4G, and 5G handsets sold, as it holds virtually all essential patents used in these networks. Qualcomm's push into automotive and Internet of Things is particularly intense. Over 200 enterprise customers are currently deploying or testing Snapdragon computing platform. Return on assets of 21% and return on equity of 90% are amongst the best returns of the industry. Profit margin of 26% is amongst the best returns of the industry. Risks. Qualcomm's chip business faces a host of challenges, from potential share loss at Samsung and Apple, to some of its customers developing mobile processor IP and design expertise in-house. Qualcomm's licensing business has faced regulatory scrutiny in the US, Taiwan, China, South Korea, and other regions. The biggest threat facing Qualcomm is a negative ruling that states its royalties should not be based on the full price of the phone. The company needs to diversify beyond smartphones, which may be challenging as a host of competitors are attempting a similar strategy. The company is expected to show a small growth in revenue. In the coming 5 years, the revenue will grow by 8% yearly. While the company has a great profitability rating, there are some minor concerns on its financial health. The company has one of the worst debt-to-equity ratios in its industry. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.